Right, good evening, everybody. I appreciate that this is a Friday evening, and I appreciate it's the Friday before reading week. So thank you for joining me if you did. Um, I did mess up the opening of the midterm this morning. I thought I'd opened it, but I had not, in fact. It's now open and it's good to go and whatnot, but I've extended the due date for another 24 hours to make up for that. So the midterm exams now due midnight at a Sunday at midnight, sorry. Um, this is a shorter than normal class today to make up for the fact that we have a midterm. Excuse me. Now we're going to talk about Chapter 18, Valuation and Capital Budgeting in a Levered Firm. We talked before about um, what happens if we fund something with all equity, and we came up with the UCF, the unlevered cash flow. And now we're going to see what happens if we actually have some sort of leverage. Because most companies have a mix of some kind between debt and equity. Most of them have some sort of a target that they're aiming for their mix between debt and equity. We really have to kind of get some sort of um, a grasp of what that means in terms of how are we going to value stuff. And um, the good news is it's really just a combination of valuing what we already have, which is all equity, and then adding on the cost of whatever debt financing we have. So there is good news, and there's three ways that we're going to look at it. And the better news is that all those three ways don't apply in all cases. So we'll find out some rules when they apply and when they don't apply. So that's really what we're looking at today. We'll start with our land acknowledgement. We're located on the land stewarded by the Anishinaabe, Haudenosaunee, and Wendat nations. We acknowledge Treaty 13 Toronto Purchase, signed with the Mississaugas, the Credit First Nations, and the Williams Treaty, signed by the Mississaugas and Chippewa First Nations. We're all interconnected as treaty people. The short version, we're on borrowed land, and we have to give that land back eventually. Some places are on more heavily borrowed land than others. The entire province of Alberta is on treaty land. So when they talk about separating, it's not, really not going to happen because they don't own the land. But we are stewarding this and we will give it back in a better condition than we find it now. What do we look at today? Value in capital budgeting. So we're going to talk about adjusting our present value approach, and it's actually called the APV, the adjusted present value approach, to look at how we value stuff. And then we're going to look at another approach called the flow to equity. And that really says that if we have debt and equity, how much of this is actually flowing back to the shareholders? And then the third way we're going to look at is the weighted average cost of capital method, which says if we have a cost of capital for equity and we have a cost of capital for debt, and we know what our combination of debt and equity is, then we can figure out what our combined or our weighted average cost is of our capital, and then we can figure out moving forward from there. We're going to compare all three approaches, and then we're going to take those and throw them upside down a little bit and say, we've been working with the knowledge of what our discount rate is. What happens if we have to estimate the discount rate? So we'll look at that, and then we'll work through an APV example of that, and then we'll talk about beta and leverage. Are there any questions before I start? Okay, then off we go. In 2024, Honda announced it's going to build four new EV plants in Ontario. The total spending is estimated to be around $15 billion, though frankly, it's not all Honda. A lot of it's tax breaks and stuff like that. The government has committed $2.5 billion. The federal government committed some. The provincial government can commit some. There's four plants that are being talked about: an assembly plant, a standalone EV battery plant, and then two other plants. Around the same time, ArcelorMittal, which is the new owners of, well, it's not really recent, but they own Stelco and they own Dofasco. So ArcelorMittal was given a tax credit to open a new plant in Alabama to make electrical steel. Electrical steel is a different kind of steel than normal that we really require to make batteries out of. We still haven't figured out how to make it not burn, but we're moving in that direction. So now the question is, if we have subsidized debt, like the $2.5 billion of tax credits, how does that impact what it costs us to fund our company? And how do we figure that out? Because when we figure that out, I'm sorry, I'm just answering a question here on chat. I apologize. Um, I'm very sure I made the midterm Sunday night, not tonight. Give me half a second and I will check on that. So don't go anywhere, anybody. I'm just going to pause the there we are. It's now recording again. Now we're back to our lesson. So, how do we evaluate what's that worth? When we consider a project, so far we've looked at if we calculate the NPV of the project, and that is, we pay out money today and we get money back in installments over the course of the next whatever many years. And then we have to figure out what that's all worth today. So we say, this is what we pay out today, and this is the value of all our cash flows today. How do they compare? If the number is positive, called the NPV, then we'll say, over time, the present value of everything we get back is worth more than the present value of what we're paying. So we're going to go forward with this as a project. Now, what happens if we start to get debt costs or even financial benefits like subsidies and stuff like that involved? How does that impact the MPV? We learned last week um, that when we um, are smaller shareholders in a company, but higher in management, we're likely to get paid more than if we were the owners of the company, but we're also likely to take on more risky investments. Does it feed into that or not? Is this part of that same discussion? So we're going to have a look at that. We're going to talk about an approach called the adjusted present value approach, the APV. I promise that's coffee, not bourbon. Um, so the APV is the NPV, which we would normally calculate anyway. And then if there's any benefits to either issuing debt or any other financial side effects, we're going to add those on as well. So we're going to get to some cases where we may well actually have a project that has, if we were financing solely with equity, a negative NPV. And in that case, we would say, no interest. Thank you. We'll walk away. This doesn't suit. But if we add on the effects of financing or the effects of subsidies and stuff like that, all of a sudden the project becomes more interesting because the parameters change around it. And a project that we would normally look at the NPV of and say no interest, we can now say no interest. But when we factor in the costs of um, funding, or the positive side effects of the tax shield from interests, for example, suddenly it becomes positive. So we're going to look at that. Specifically, we're going to look at what's the tax subsidy to debt? When we issue debt and we have to pay interest, do we get a tax break for that? And the answer is yes. What is the cost of issuing new securities? We already know that there's a cost of issuing equity. What's the cost of issuing new securities? And then when we talked about debt originally, we say, one of the fundamental costs of debt is the cost of financial distress. As the odds or the probabilities of bankruptcy build up, or we put conditions in place that make it more likely. For example, if we had no debt, we probably wouldn't go bankrupt. But all of a sudden, when we have debt, now the probability of bankruptcy goes up higher than what we had before. It may not be massive, but it's there, and we have to figure that out. And then when we finance using debt, are there any natural subsidies that we get from that? Now, of all of these, the tax subsidy to debt is undeniably the most important. It's going to be the highest dollar value of any of the others. So let's look at that one first. And we have to understand that there is a tax shield from interest because it reduces, it's a cost that reduces our pre-tax income and then reduces our after-tax income. So as long as we have this tax shield, we better figure out how to use it and what it's worth. So the tax subsidy to debt. Consider the following. Oh, by the way, I've got everything that I'm going to talk about in a spreadsheet as well, and I'll be flipping back and forth between the spreadsheet and PowerPoint because it's easier for me to show you the math on the spreadsheet than it is on the. I mean, I can show you the formulas and whatnot, but I can show you how everything is involved on the spreadsheet. So we're going to do that too. So consider the following project. We have $500,000 per annum inflows forever. We have 383,038 per annum in costs forever. The initial investment we have to make for this is $475,000. Our corporate tax rate is 21%. Yeah, no, it's in the US. And the cost of capital for equity finance projects is 20%. Now, we have to think about something for a minute. What is our present value? And what we're going to say is we want to find out what our unlevered cash flow is first, and then figure out from that unlevered cash flow what our present value of those cash flows is. Then, when we have the present value of those cash flows, we can look at the initial investment, compare the two, and say, does this make sense? So, to get our cash flows, what we have to do, uh, so here are all the parameters. Cash inflows of 500,000, outflows is 383, initial investment of 475, corporate tax rate of 21%, and cost of capital of 20%. That gives us our modified income statement, where we have inflows and outflows. So we have our operating income of the difference between the two, which is 116,962. Our corporate tax rate's 21%, so that's 24,000, etc. Our unlevered cash flow is our operating income less our tax, which is 92,400. How do we figure out the PV of that? Well, to figure out the PV of that here, we'll take our unlevered cash flows over the cost of capital for equity financing, and that gives us 92,400 divided by 20%, or 462,000. So this is the present value of a perpetuity, which is the cash flow per year in the perpetuity divided by the cost of capital. And if you don't believe me, it is somewhere here. PV is 462, which is 92,400 divided by the cost of capital of 20%. Now, our initial investment was 475,000. The PV of all of our payments coming back to us is 462,000. You don't have to be a genius to figure out that we're paying more money than we're receiving. So we're going to get a negative NPV. And in fact, the negative NPV is 13,000. So if on a pure equity basis, we looked at this investment and said, we're funding this out of internal equity, our cost of capital is 20%. Does this make sense? No, it does not make sense. We have a negative NPV. We would say, no, thank you very much. We would walk away. So let's change the rules a little bit. Now, we talked about the PV being before the investment is subtracted. We have our cash flows, return on capital gives us our PV. Our NPV is the PV minus the initial cost, so we have negative $13,000. We would say no. We would not say we would if there's equity financed only. We would say it doesn't make hurdle because we have a negative NPV. Now, what if we had to fund part of this? And we fund this with 121,900 of perpetual debt. And I'm going to get back to why we picked this number, but just for the time being, we picked a number. So what do we actually have? We have $475,000 that we're paying. That's the initial cost is 475,000. That's comprised of $121,900 in debt and $353,100 of equity financing. Together equal $475,000. So what do we do? The NPV, the APV, the adjusted present value, is the NPV of the project under leverage. We figured some things out already, right? The NPV is now minus 13,000. We figured that out right here. Now then, we have a tax rate of 21%, and we have the debt of 121,900. What we're going to do is say, is there a benefit to the borrowing of debt? Yes. And the benefit is the debt minus the tax attached to it. So we have 121,900 in debt. Roughly a fifth of that is roughly 22,000. We already have a minus NPV of 13,000, so we combine the two together and we get a plus 12,599. Whereas before, we would have said, not a ton of interest in this because it's got a negative NPV. If we fund part of it with debt, all of a sudden we get a benefit from taxation on the interest. And that benefit of the taxation on the interest is going to be 21%, which is the tax rate, times the amount of debt we have. So if we combine that with the negative NPV, we actually now have a positive number. And we're going to accept this. We're going to accept this saying, because we have a tax benefit attached to the debt, it alters the NPV and moves it from a negative 13,000 under purely equity financing to plus 12,000, let's say 12,600, in a combination of debt and equity. Now, it shouldn't be a huge surprise. This benefit number is going to change as we change the combination of debt and equity. Because what we're looking at is what's the value under pure equity? What's the benefit of debt? And how do these change as we move them around? In our case, we chose 121,900 because that gives us roughly a ratio of 25% ratio of debt to value. Our present value divided by our debt gives us our ratio of debt. Our present value, the present value is 462,000. The debt is 121,900, and that is about a quarter. So our debt to value is about a quarter. I was going to go somewhere with that, and I totally don't remember what it was, so I apologize. No, we're looking at a fixed portion, a fixed portion of debt to present value. We're calling that our ratio of debt to value. It's related to debt to equity, but it's not quite the same. And it's very consistent with the discussion we had last week that in spite of the fact that you probably shouldn't do any sort of debt to equity targeting, everybody does. So if everybody does, let's figure out how to work in a world that adjusts for that. Especially how, right here in the bottom, banks usually lend as a fixed percentage of appraised market value of the project, sorry, not the initial investment. What is the appraised market value? I don't care what you had to pay for it. What's it actually worth? And what's it actually worth is the PV. So we're going to do banks lend as a percentage of PV, and that is the ratio of debt to PV, and that's 25%. So we have our first answer. Of the three things we're going to look at, we now have APV. And APV is the NPV plus any positive effects of financing. And in our case, there's ways to look at all the other stuff too, but because tax was the biggest issue, tax is the one we're going to look at. So an alternative approach is to say, we know what our cost of equity is. How do we figure out how much is flowing back to our shareholders, the flow to equity, using what we know. And there's three things that we have to do now. The first is we have to calculate the levered cash flow. UCF we calculated before. That's the unlevered cash flow. Now we're going to calculate the levered cash flow. After that, we're going to figure out what the cost of equity for capital is. And then we're going to put all that stuff together for evaluation. Come along on the journey. So how do we figure levered cash flow? Our levered cash flow has the same parameters: 500,000 in, 383,038 out. Net, we have, sorry, just a second. We also have one more cash flow to go out, though. And that cash flow is the interest rate, the interest component, sorry. We've assumed an interest rate of 10%, only because you have to assume something. Remember, we're borrowing 121,900. 10% interest rate gives us 12,190. So now we have the cash flow coming in as 500. The cash flow going out is 383,038, and we have interest payments going out as well of 12,190. That gives us our after interest cash flow or income of 104,772. We still have a 21% tax rate. So our levered cash flow is going to be our after-tax cash flow of 82,770. Remember, our unlevered cash flow was 92,400. So once we add the impact of the interest payments, that drops to 82,770. Now, quick aside. The difference between unlevered cash flow and levered cash flow is the after-tax interest payment. It's the after-tax value of this little baby right here, the 12,190. And the difference between 24,562 and 22,002 is going to be the 21% of 12,190. So our 10% interest is 12,190. The after-tax equivalent of that is the difference between unlevered cash flow and levered cash flow. And what is that? Well, I don't think it's RBB. I think it's RB. It's 1 minus the corporate tax rate, which is 21%, so 79%, and whatever the interest payment is that's left. And the interest payment that's left is going to be 1,290 minus 79% of 1,290. So let's have a gander here. UCF is equals to LCF. So unlevered cash flow minus the levered cash flow is equal to 1 minus the corporate tax rate times the bond payment. Or if you want, it is 1 minus 0.79. Not sure what I've done down there. Sorry. So at 92,400 minus 9630 is equal to 82,770. 82,770 is the levered cash flow. 92,400 is the unlevered cash flow. And the 9630 is what's left of the 1,290 after we take the tax off. Or if you want, it is the 121,900 the interest rate is 10%, so that gives us our 12,090 right there. 79% of 12,090 is 9630. So that's how we come up with this figuring the flow to equity. So now we've figured out calculating the levered cash flow. The next step is to calculate the discount rate of equity. We've assumed the discount rate of unlevered equity is 20%. We got that from our initial assumption here. Cost of capital for all equity is 20%. So that's the unlevered portion is 20%. Our levered discount rate is going to be the unlevered discount rate plus bonds over stock times 1 minus the tax rate times the return on stock versus return on bonds. What's this telling us? Well, we have our debt to equity ratio, and we gave our value to debt at 25% equals debt to equity of 1/3. Debt to value of 25% equals debt to equity of 1/3. So when we have our debt to value of 25%, where are we at here? Here. We have our debt to value of 25%. That gives us here our debt to equity ratio of 1/3. So what we're going to have is we're going to have our unlevered cost of capital is 20%. So that we know. Now we've got to figure out what the impact is of the levered part. And the levered part is going to be 1/3 because that's the debt portion, times whatever's left after taxes, 79%, times the difference between the discount rate for unlevered equity and the discount rate for bonds. The discount rate for bonds is the risk-free premium, which is 10%. The discount rate for unlevered equity is 20%. The difference is 10%. So to calculate our return on levered equity, or RS, RS is equal to the 20% that we have already, plus 1/3 of 0.79 times 0.1, or 2.63%. So we have the 20% from unlevered equity. Yeah, you're right. I did make a mistake, and I'm going to fix that. Thank you very much. 20% of unlevered equity plus the 2.63% from the levered portion, add them together. Now we have our cost for levered equity of 22.63%. So it's the 20% plus the 2.63% that we get from the debt. How do we figure out what the PV of the project is now? Well, we know what the levered cash flow is. That's 82,770. We now know what our discount rate is that we're using for our levered equity, 2263. So 8270 divided by 2263 is 365,999. And that's very consistent with what we did. We did here somewhere. Here, where we had the unlevered cash flow of 92,400 divided by the unlevered equity cost of capital of 20%. That's 462. We're doing the same thing here, but we're using the levered now of 82,770 and the new levered cost of capital, which we just calculated at 2263. Yeah. Now we had the initial investment of 475 and we borrowed 121,900. So the firm has to advance 353,100 out of equity or cash reserves or something. This is not borrowed. This is funded internally. The NPV is the difference between what we have to fund internally and the new present value of the leveraged cash flows. The new present value of the leveraged cash flows is 365,699. What we have to fund internally is at 353,100. 365,699 minus 353,100 is 12,599. It is identical to what we calculated here. Oops, sorry. What we calculated here. Wait a minute. What we calculated here, the APV, was the NPV plus the tax impact of the bonds, and that gave us 12,599 plus instead of minus. When we did our flow to equity approach, we ended up with having to finance 353 ourselves, but we have cash flow coming back to us of 365,699. So the cash flow coming back to us compared to what we have to finance ourselves is exactly the same as what we came up with on the APV approach. So there's two ways to look at it now that match. The third way is to say, let's pull this apart a little bit further. Let's pull this apart just a little bit further and say, you know something? We know that we have a weighted average cost of capital. And we know that weighted average cost of capital is going to be a combination of the weighted cost of capital from equity and the weighted cost of capital from bonds. So the cost of equity, RS, is going to be adjusted for the proportion of the value of the company, bonds and stocks, that are attributed to stocks. So stocks over bonds plus stocks gives us the proportion of the company that's funded by equity, and we're going to multiply that by the cost of capital for equity. What's left is the portion that's funded by debt, and that we're going to do is the cost of capital for debt times 1 minus the tax rate. So we get rid of the tax impact. So we know it's 21%. We know that whatever it is 79% of it's left. Of the 79% that's left, we want to know what the proportion is that's bonds to the value of the company. So if we looked at what the proportion was stocks to the value of the company, we can look at the portion of what bonds to the value of the company is, and the combination of those two pieces is going to be our weighted average cost of capital. So we're going to ignore taxes for the time being. Blah, blah, blah. Once we put taxes back in, it changes the equation though. So up here, waiting for equities is stocks over stocks as bonds. Waiting for bonds is bonds over stocks as bonds. They're both target ratios. They both use market values, not book values. Remember that. So let's move forward. Formula calls for discounting UCF at the WACC. So we're going to have to come back to that in a minute. Specifically, the WACC, or the weighted average cost of capital, is going to be the cost of capital for equities times the proportion of equities, and then the cost of capital for bonds minus tax, so whatever's left, which is 79%, by the proportion of bonds. Then we're going to say, what is our UCF? The value then becomes, what is our new unlevered cash flows over 1 minus the WACC as a proportion minus the initial investment. So UCF over 1 minus WACC is the PV that we're left with minus the initial investment to get the NPV. All right. We're going to assume the project runs to perpetuity because that's what we did before. So UCF over 1 minus WACC minus the initial investment is going to give us what we're looking for. If we have a debt to equity ratio of 1 to 4, 1 to 3, sorry, we have 75% equity and 25% debt, so it's 1 to 3. We have our WACC, which uh, we calculate the WACC here at 22.63%. So we know that we have 75% of 22.63 is the equity component of what our weighted capital cost of capital will be. Um, the cost of bonds is going to be the return, the cost of capital for bonds, which we're looking at is the risk-free interest rate of 10%. Um, After tax, there's 79% of that left, so we have to look at that. And then 25% of the total is what we're looking at. So it's 25% of 10% times 79%. And then we're adding that to 75% of 22.63. So we get the two pieces, and then we add the two pieces together. That gives us our combined weighted average cost of capital of 18.95%. So now we see the cost of capital was 20% under equity only. It drops to 18.95% when we combine the positive value of debt, in spite of the fact that only a quarter of our total makeup is debt. So you can see that if we increase that debt even more, the weighted average cost of capital would fall even more. Now then, what is our um, unlevered cash flow? I'm sorry, total mind blank there. Um, Over this new WACC of 1895 minus the initial investment would give us 92,400 divided by 1895 minus 475,000. 92,400 divided by 1895 is 487,599 minus the 475,000 the initial investment gives us, whoa, 12,599. It's exactly the same number. Doesn't matter how we calculate, it's exactly the same number. So why am I giving you three ways to calculate it then? That doesn't make any sense. Now you're just confusing me. Well, sort of. Um, I appreciate that it is confusing, and I appreciate that um, figuring out when to use each one is going to be a problem, which I'm going to solve for you right now. Because um, you don't always have all the components. If you don't always have all the components, you've got to figure out which one to use when you have the components that you do have. When do you use? The APV approach, the adjusted present value approach, bases on an all equity basis. After tax cash flows are unlevered, and then we discount them at the discount rate for our unlevered equity, and that gives us the NP, and then we add the NPV of the debt. So um, this gives us our way to look at the equity component and then the debt component. The flow to equity takes a slightly different approach and says we know what the levered cash flows are, and that's the unlevered cash flows adjusted for the interest rates. And we know that if we have, well, we know the difference between the levered cash flow and the unlevered cash flow should be the interest expense less the tax component. So it should be 79% of the interest expense. And 79, what's the interest expense? Let me see if I can prove this to you. The interest expense is 12,190. 12,190 times 0.79 is 96,301. When we work our way through all of these examples, where do you get to 96,301? Beep, 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 beep. We'll go back to here. Where do we get to 96,301? 9630. So this is the interest expense minus the 21% of taxes. So flow to equity is looking at our levered cash flows, and then we're discounting whatever the capital is that we're returning to shareholders. So we had to calculate what the return on equity to levered capital was first, and then we can discount the new levered cash flows by that number. Now, levered cash, our levered cost of funds has to be higher than our unlevered cost of funds in an unleveraged firm. It has to be. We have our three calculations over here to the right. The WAC says we're going to calculate the after-tax cash flows assuming all equity finance. So it's the UCF. Then we have to figure out what that is. So the UCF is going to give us the unlevered equity portion of the cost of funds. Then we have to figure out what the cost of funds is for the levered part. And then we add those two together, and that gives us our three. Notice that the numerator in the third case doesn't really mention debt at all, but that's fine. So in this case, we have the unlevered cash flow divided by the WAC minus the initial investment. So all three seek evaluation in the presence of debt financing. We've got three different ways to do it now. Here they're all three. Let's compare the three approaches and say, okay, it still doesn't make any sense to me. Why do we use these? APV versus WAC are the closest to each other. They both have UCF in the numerator. APV discounts the UCF at the unlevered cost of capital and then adds the tax shield to it. WAC takes the pieces and tries to figure what the individual pieces are and then adds them together. And then we use the WAC to look at whatever the unlevered cash flow is. Once we have our weighted average cost of capital, we look at the unlevered cost, the unlevered cash flow divided by this new cost of capital, and that gives us the equity, the weighted average capital approach. FTE approach is the most different. It assumes what's flowing back to equity holders. I don't care about debt holders to the time being. What's flowing back to equity holders, because those are the people that own the company. What of the cash flows that flow back to them, what's the return on that? So that's the three different approaches. When do you use them? Well, the good news is if you get that wrong, the NPVs are all the same. The bad news is if you get it wrong, you're not going to have all the right inputs. So, which is better, WAC or FTE? If risk remains constant, then it's plausible that the return on capital of unlevered firms remains constant too. Big words, what's it mean? For risk to remain constant, we don't add anything to the equation that carries risk with it. That must mean we have not added debt. So if risk remains constant, we did not add debt, then the return on unlevered capital must remain constant as well. All right, one. If the debt to value ratio remains constant, then the debt to equity ratio also remains constant. The WAC and the return on levered capital will also remain constant. So as long as we have a debt to value ratio that remains constant, WAC is likely the better approach. If risk and debt ratios change, however, both the return on levered capital and the weighted average cost of capital is also going to change. Then it becomes problematic. So in situations where we have flux, where risk and debt changes through the course of the equation, we need to find a better way. And that's not going to be WAC. It's going to be FTE. If the debt to value changes from year to year, it's problematic. And in that case, we're going to use APV. Um, if a firm plans to use a certain level of debt in each future period, APV is way better. It doesn't have to be the same level of debt, but it has to be a level of debt. So as long as there is debt in future and each year it stays the same, we can use APV. All right. Which one's preferred? Depends what you're using the analysis for. Um, if we're going to do leverage buyouts, and a leverage buyout is where we borrow a whack of debt, buy the company, and then rapidly pay down that debt. That's the theory of a leverage buyout. They all work out the same way, but that's the theory of the leverage buyout. We're going to know the schedule where we pay down debt in advance. Because we have a altering level of debt every year, WAC and FTE are not going to work. Because the debt to equity value will not be steady over time. In cases where, so APV handles that well. It handles lease and buy decisions very well. Where we have targeted debt to value ratios, then we're going to use WAC and FTE more often. So those are really the two differences there. Oh, and of the choice between WAC and FTE, WAC is definitely the one that most business executives look at. So FTE is nice. Realistically, we're choosing between APV and WAC. Let's look at examples. As previously mentioned, most companies tend to target debt to equity ratios in spite of the fact that we shouldn't, but that's fine. That suits WAC well, but not APV well. If there's side benefits to the debt or side costs to the debt, APV works better. The problem is it's trickier. So here we are. Bixler Enterprises considers it. I need new glasses. I can't see anything through these. Sorry. Considers a $10 million project. There's a 5-year time frame. It's going to use straight line depreciation, $2 million a year. Cash revenues less costs, so cash in minus cash out is $3.5 million a year. The corporate tax rate is 21%. The risk-free rate on bonds is 10%, and the cost of equity is 20%. What do we think of this investment? Well, this one's definitely easier to do this way. Where's Brixler? Brixler, here we are. So we have a $10 million project, a 5-year time frame. Straight line depreciation is $2 million. Cash, the net cash is $3.5 million, 21%, 10%, and 20%. Our initial outlay in year 0 is $10 million. The depreciation tax shield is our straight line depreciation of $2 million times our tax rate of 21%. 21% times 2 million is 420,000 a year. So that's the benefit we get from the tax shield. Revenues less expenses are $3.5 million. And 1 minus the tax rate, remember it was 1 minus TC, or 1 minus 21%, or 79%. 79% of $3.5 million is $2.765 million each year. All right. So now we know the after-tax impact of everything so far. Our initial cost of equity is $10 million. We know that. The depreciation tax shield is 400. Oh, I'm sorry. Depreciation tax shield is our 420,000 times 5. We have um, sorry, it's right here. 1 divided by 1 plus the risk-free rate, which is the 10%, to the power of 5 years. That's going to be the depreciation tax shield. The depreciation tax shield is 1 over 1.1 to the power of 5, which is 0.621. 1 minus that is 0.38. Our 404.2 million times the 0.38 is 1.592. The PV of our cash flows is 13,825. Divided by the cost of equity, which was 20%. Sorry, it's 1 plus the cost of equity, so it's 1.2. 1 divided by 1.2 to the power of 5 is 0.4. 1 minus 0.4 is 0.6. 13,825 times 0.6 is 8,265,000. So what we end up with is the MPV is $10 million out, 1.592 in, and sorry, 1.592 in and 8.269 in. The net is we have out 138,826. We have a negative NPV. In an all equity firm, we would reject this because there's a negative NPV. Fine. What if we add debt? So this is where we're at now. We have a negative NPV of 138,826.99. What if we add debt? What if we add $7.5 million in non-amortizing 5-year debt? We're assuming it's at the risk-free rate, and we're taking out flotation costs. Usually flotation costs are 1% of gross. If flotation costs are 1% of gross, the pre-flotation cost has to be the debt plus the flotation cost. So our after financing flotation cost is 7.75, etc. We know that it's 10% interest. So if we go back here, 7.5 million. We have 1 minus the 1%, so it's 99. 7.5 million divided by 99% is 7,575,000, blah, blah, blah. We have a 10% interest rate, which we already said, amortizing at the risk-free rate, which is 10%. So our flotation costs are 75,758 per year. We have 5 years. Sorry, our flotation cost is going to be 7.5 this minus the original cost, so that's 75,000. Amortized over 5 years because it's a 5-year loan. It's going to be 15,152 a year. After tax, 31,82. What is the value of the debt shield of 31,82 a year for 5 years at 10%? We could do a lot of exercises here. We go to our present value table. Present value table of 10%, 5 years is 3.7908. So we have our 3,182,000 a year after tax divided by 379.08 gives us 12,062. Our net flotation costs were the 75,758 plus the PV of the after-tax benefits. Sorry, so we have a negative cost of $75,000. We have a benefit of $12,000. Our net flotation cost is $63,696. The NPV of debt plus flotation costs is the minus 138,826.99 that we had on an equity only basis. And we have a negative flotation cost adjusted for tax flow of minus 63,696. So the NPV of the debt, and so NPV of debt plus flotation costs is going to be 202,522.53, which gets us to here. Gets us to 202,522. Okay. So our gross proceeds are 575,758. That's the 7.5 million plus the issuing cost. Interest rate's 10%. Annual interest is going to be 10% of the 7.7575 million, or 757,276. Our tax rate's 21%. So our after-tax interest is 79%. What's 21%? That's our annual interest minus the tax benefits, so that leaves us a 79% remaining, which is the 598,485. Just in case you think I'm lying. 598,485. So the NPV of our loan is the amount we borrowed, which was not the 7.5 million, but the 7,575,758, plus the after-tax interest rate, which is 8131. Oh, where'd it come with money? Where'd it come with this from? 127 over 124. Oh, 107. So the after our interest payments after tax of 598,485 divided by our interest rate of 10%. And that gives us the after-tax interest of 2,268,000, blah, blah, blah. The PV of the loan payments is the 5,575,000 times 2 D times E. Oh. Poopy. All right. This is the equity component. This is the debt component. So the debt component piece is loan payments of 4,703,000. We borrowed 7,557,000. We have benefits after tax from interest payments of 2,268,000. We have the PV of loan payments of 4,705,000. That gives us a adjusted positive NPV of 603,080. So this is the benefit of all the tax shields that we have. That gets us here. The NPV of the loan is positive, so it's reflecting our tax shields. The adjusted PV is the all equity PV, which is negative. We know that the negative all equity number of 138, 826, etc. The flotation cost of debt, and the flotation cost of debt was 63,696, plus the NPV of the loan now, which is 603,080. So we have minus 138 minus the cost of debt plus the NPV of the loan. The adjusted PV is positive now of 400,557. So now we look at it and say, we're good. We know now. We have two different ways to look at this that gives us an answer that says we can move forward. Now, we've really only looked at two things. What's the flotation cost? So if it's going to cost 1% to issue debt, then our debt amount of $7.5 million is actually only 99%. So we have to figure out what 100% is, and that's 7.5 million divided by 99% to get us to 100%. That's 7,570, whatever. From there, we can figure out what the costs are. Then we can also figure out what the tax subsidy is, because we figure out what's left after the tax rate's taken out, or 79% of whatever's left. What happens if we find financing that doesn't involve the market 10% rate? What happens if province steps up or a state steps up and says, you know something, we can do that at 8% just because we like you, because you're Stellantis and you're building a battery plant, for example, and we're going to suck up the flotation costs too. So you get a cheaper interest rate and we suck up the flotation cost. Does that sound good to you? Why don't we do the math and figure that out? So we receive a loan of $7.5 million. What's the interest we pay? The interest is $7.5 million times 8%, which is $600,000 a year. For year 1, 2, 3, 4, 5. What's the after-tax interest? 79% of that, or 1 minus 21%, whichever we want to look at. 79% of 600,000 is 474,000. So that's our after-tax interest rate. And then in year 5, we'll repay the loan. So we have to figure out three pieces here. What do we actually pay? Well, we'll figure it out. So we had the initial cost of $7.5 million. We have to depreciate this strip of payments. This strip of payments is 474,000. Sorry, we have 474,000 divided by 0.1, which is our risk-free interest rate. If we look at the risk-free interest rate to the power of 5 and then multiply it through again, we end up with the depreciated strip of payments of 1,796,000, and that's these 5 payments of 474 each brought backwards to now. Then we have to repay this $7.5 million. The $7.5 million is our repayment. And we figure that out by 1 over the risk-free interest rate, which is 10%. So 1.1 over 1.1 to the power of 5, which is 62, etc. So the depreciated principal repayment value is 4,064,000. The initial cost, 7.5 million. Depreciated strip of payments is 1.796. And depreciated principal repayment is 4.656 million. The NPV of the project now on an unlevered basis is 1,046,257,175. All right. The APV is the all equity value minus the flotation costs plus the NPV of the loan. We know the flotation costs are zero because the province or state was nice enough to say on me. The all equity piece we know is negative. We know it's minus 138, 826.99. That's not going to change. Where are we here? Oh Lord, where did I get to? Here. Where did I get to? I don't know, too. What number, right? We know the NPV of the loan is 1,046,257. So we end up with 907,430. I still don't think this number's right. There. Why does it keep going down like that? Well, because that's actually the number. I'm sorry. Eh, I'm lost again. Here. So the all equity cost is 138,827. The NPV of the loan is 1,046 from over here. The combination of the two of equity financing and the NPV of the loan gives us an APV of 907,430. It's all good. We're happy people. Um, I just did that. Okay. Now, what's beta? Now, we've talked before about beta. Um, how do things change? How does the value of equity change? How does value of debt change? How do they compare to each other? We know that assets equal debt plus equity. Uh, we know that equity is equal to assets times 1 plus the proportion of debt to equity, because we have to adjust assets for the amount that's debt. So equity is equal to assets minus the debt piece. That makes sense. If debt plus equity, if assets equal debt plus equity, then equity equals assets minus debt, right? Um, it holds without taxes. It also holds when the beta of debt is zero. But now, if we look at a world where there are corporate taxes, how does that change our equation here? And it changes the equation very similar to APV, because the beta of equity is going to be the beta of an unlevered firm times the difference between whatever's left after tax in debt over equity. So it's not really the relationship of debt to equity. It's the after-tax debt to equity that we care about now. As long as debt has a zero beta. Um, it also has to be greater than 1 for a levered firm. So the beta for an unlevered firm is less than the beta for a levered firm. So where do we go from here? Let's consider the next one. And I'll go back to my spreadsheet here. CF Lease consider making an upscale financing package of debt of $100 million. Before we issue the debt, we have equity of $200 million in the firm. Debt is considered risk-free. We can talk about that later. Corporate tax is 21%. Regression says the beta of equity is 2. So we'll just take that as true. And the risk-free rate is 10%. So what's the all equity discount rate now? The beta of an unlevered firm is equal to equity divided by the after-tax value of debt times the beta for equity. So we know that equity is 200 and debt's 100. We know that the tax rate's 21%, so what's left after tax is 79%. We know that what else do we know? Um, oh, I'm sorry. So we know that 79% of debt, which is 100 million, so 790,000, or 79 million, sorry, it's 100 million, 79% is 79 million. We have equity of 200 million. So we're going to have beta equity of the unlevered firm is 279 million. We know that the beta on equity is 2 because that's what we were told. The beta of our unlevered firm is going to be 1.43. How do we know that? Well, our equity divided by our debt to equity combination of 79% of 279 million gives us 71%. So 200 million is 79%, 71.7% of 279 million. The beta is 2, so 71.7% times 2 is 1.433333. So now we have the pieces that we need. To determine the discount rate, we need our risk-free rate, which is 10%. We need our beta, which is 1.43, which we just calculated here, and that is the proportion of equity to the newly levered value of debt plus equity. That's 1.433. And then we know that 8.5%, sorry, is oh Lord. Right back to the start here. Where do you get 8.5%? 8.5% came from the market risk premium of 8.5%. So we have a market risk premium of 8.5%. So 10% plus 1.43 times the market risk premium. 1.43 times that is 12.2% about. So 22.2% about is our levered cost of capital, RS. So now we have the idea of what beta and leverage do to us. Now we've assumed that when we did this financing, we're going to have scale enhancing. And that is, we borrow $100 million because that's going to let us leap forward. And we're not now making this on 5 pieces, we're making this on 500 pieces. So we've added scale all of a sudden. But what happens if we don't add scale? What happens if we're just borrowing to keep going? So let's look at a case of J. Lowe's Corporation. J. Lowe's Corporation, sorry, I am pushing through this. We're not having a break because we're done in 2 slides. So J. Lowe's Corporation makes staples. We're going to add $1 million of investment to continue going forward. The estimated unlevered cash flow is $300,000 a year in perpetuity. We're going to fund with a debt to value ratio of 1/2. If we have a debt to value ratio of 1/2, we have a debt to equity ratio of 1. So debt to value is debt to assets, and debt to equity is 1. All right. Our 3 closest competitors are unlevered as well. They have betas of 1.2, 1.3, 1.4. Our risk-free rate is 5%, not $5. Market risk premium is 9%, tax rate's 21%. What's the NPV? Okay. The beta for equity is going to be 1 plus the proportion of after-tax debt to equity times the beta for the unlevered firm. Now we don't have our own beta. So what we're going to do is we're going to monkey around a little bit. And what we're going to do is we're going to take the beta of our 3 competitors, find out what the average there is, and use that instead. So if we have betas of 1.2, 1.3, and 1.4, the average is 1.2 plus 1.3 plus 1.4 divided by 3 is 1.3. So we're going to use that as our unlevered beta. So the amount of debt, the proportion of after-tax debt is 79%. The proportion of after-tax equity is 1. Remember, we have a 1-to-1 ratio. So 0.79 divided by 1 is 1.79. Our unlevered is 1.3. So 1.79 times 1.3 is 2.33. The levered beta of the new project is 2.33. Okay. To get our cost of funds, RS is equal to RF, which is the risk-free cost of funds, which is 5%, times the beta, which is 2.33, times the risk premium, which in our case is 9%. We were using 8.5 before, now we're using 9%. So what do we have? We have 5% plus 2.33 what's F9? Oh, 9%. Sorry. 2.33 divided by the 9%. Sorry, times 9% gives us 0.20943. Jumping all those things together now, we have our levered cost of equity is 5% plus 0.2093 times 9%, which is 25%, 9% divided by 0.20. If we add the two pieces together, we end up with 25.94%. Um, how do we get that? We get our G198, which is the 2.0933, which is the beta divided by our risk premium. And we're adding that to 190, so 2.33. Anyway, we end up with 25.94%. Going from there, we calculate the WACC now. Our WACC is the proportion of bonds to the risk-free rate for bonds after tax, and the risk-free rate for, sorry, the levered rate for capital times the amount of capital we're using. What do we have? Bonds are 50%, equity are 50%. That makes that easy. The risk-free rate's 5%. The after-tax component, so 1 minus 21%, 79%. 79%, sorry, 50% times 5% times 79%. The value of the cost that we're attributing to bonds are 1.975%. What we're attributing to equities is 50% of the value of the firm times our levered cost of funds of 25.94%. And so it's 50% of that is 12.975%. Add the two together, we get 14.95% as the WACC of the project. Our unlevered cash flows were $300,000. The WACC of the project is 14.95%. That gives us a value of 2.07 of our PV of stuff coming back to us. Our initial investment was $1 million. The difference between our cash flows and our initial investment, we have $1 million positive present value. That's where we get here. So that's really what I wanted to talk to you about before the test today. The introduction of taxes and bankruptcy charges changed the firm's financing decisions. Do we do only equity? If we're not doing only equity, then we're introducing risk into the equation. If we introduce risk into the equation, what's the added cost of that risk? We can calculate it. It's not impossible. We got to figure out if we're putting risk into lower rates, we have to compensate for the fact that yeah, we've lowered rates, but we've brought risk into the equation too, and we've got to compensate for that. Most rational corporations incorporate some debt. We know that because it's cheaper. Now we look at three ways to calculate the adjusted present value, the flow to equity, which isn't used that often, and the weighted average capital cost. The two that I really want you to concentrate on, the APV and the WACC. Those are the two that you're going to use most often going forward. And that's what I've got for you. I hope you guys have an astounding reading week. Don't be too perturbed by this midterm. Just get it over with and get it done. And then take some time, please. You've got a week. I know you've got a lot of work to do, and I know you're going to be working all the way through it. But remember, you've got a week, so take a minute or two to relax and get your batteries back up to strength. You need them there. As soon as I can get this transposed and into YouTube, I'll get it onto my channel. I'm gonna try to do it tonight, and I'm gonna try to fix the errors that I noticed in the presentation as well. Are there any questions before I log off? Good question. How many essay questions? Well, I can't really answer that question for you for a reason. I specifically picked a pool of 70 questions, and every person gets 20 out of those 70. So no two people should have the same exam. So I can't really answer that question for you. I believe I set it up so that it should be somewhere around 75%. Between 60 and 75% should be multiple choice, and the rest should be essay. But it's going to be luck of the draw depending on what comes. And if there's nothing else, good luck, my friends. Have a good week, and I'll talk to you in a week from now, 2 weeks from now. Have a good evening.